this podcast. I'm Shashank, and today we are going to discuss a highly debated topic in Indian fiscal policy, that is inheritance tax. In April 2024, a single statement by Congress leader Sam Pitroda created a buzz around inheritance tax in India. His comments sparked nationwide debates and raised certain fundamental questions about wealth distribution in our country. But here is what most people don't know. India actually had an inheritance tax for nearly 3 decades, and then we completely abolished it. Today I am going to take you through the complete story of inheritance tax in India, its rise, its spectacular fall, and the burning question that's dividing economists, policymakers, and citizens alike. Should inheritance tax make a comeback in India? By the end of this episode, you will have some understanding of why this is not just a policy debate but a question that could perhaps reshape India's economic future. Let's dive into it. Let's start with the fundamentals because there is a lot of confusion among some people regarding what actually inheritance tax means. Simply put, inheritance tax is a levy imposed on assets transferred from a deceased person to their heirs. Unlike income tax, which you pay on your earnings, inheritance tax is paid on wealth you receive from someone who has died. Now, when I say assets, I mean everything: your ancestral home, the piece of agricultural land in your village, bank accounts, jewelry, shares, bonds, and even that vintage car that your grandfather left you. Essentially, everything that has monetary value becomes part of inheritance tax calculation. Now, let me take you little back in time because this concept of taxing inherited wealth is not new. Modern inheritance taxes they emerged in the late 19th century. The United Kingdom introduced death duties in 1894, and the United States followed suit in 1916. These were not just revenue measures; they were social engineering tools designed to prevent creation of permanent aristocracies based on inherited wealth. And India's tryst with this concept began during the British rule, but the real story starts post independence. Let's picture this. It's 1953, and India is just 6 years old as an independent nation. And Finance Minister C.D. Deshmukh he introduces the State Duty Act. The ambition was enormous. It was to reduce the wealth concentration and generate revenue for a newly independent nation which is desperately trying to build its infrastructure. The tax rates under that State Duty Act that was introduced by C.D. Deshmukh, they were steep. And I mean absolutely steep. They ranged from 7.5% to a whooping 85% on the states valued above rupees 1 lakh. Can you imagine if your parents left you property worth rupees 1 crore? The government could take away 85 lakhs from you. For 32 years, that is from 1953 till 1985, this law, State Duty Act, remained on our statute book. But here is the interesting thing. It told a story of unfulfilled promises, mounting administrative nightmares, and ultimately complete policy failure. By 1985, the writing was clearly on the wall. Finance Minister V.P. Singh he took the bold step of repealing the State Duty Act entirely. And when you look at the reasons why, you will understand why inheritance taxes are so challenging to implement in developing economies like India was in the 1980s. First among many reported reasons was that revenue generation was absolutely dismal. Despite those punitive tax rates of up to 85%, the state duty contributed less than 0.5% of total tax revenue of India. In many years, the administrative cost of collecting this tax actually exceeded the revenue that it generated. That was like a living example of policy inefficiency. And moreover, tax evasion that had become an art form. Wealthy families they found incredibly, innovative ways to circumvent the law. They created benami transactions where assets were held in someone else's name. They systematically undervalued assets during assessment. They converted black money into what appeared to be legitimate inheritance. They set up complex trust structures that made asset tracing nearly impossible. In addition to that, the law had serious macroeconomic implications as it inadvertently encouraged capital flight. Many wealthy Indians they moved their assets overseas or relocated themselves entirely to avoid the tax. During those crucial early decades of development, India was literally losing the capital that it desperately needed. Because of that, and that state duty had some substantial contribution to that. And the administrative challenges were simply, they were overwhelming. Now think about the complexity. Valuing everything from prime Mumbai real estate to agricultural land in remote villages, from traditional jewelry to family businesses, the tax department, they lack the expertise, the technology, and frankly, manpower to handle this effectively. Now let's look at how the rest of the world is handling inheritance taxation today, because the global scenario might surprise you. Currently, only about 24 countries worldwide they levy some form of inheritance or state tax. The usual suspects are there like the United Kingdom, USA, France, Germany, Japan, and South Korea. But here's the interesting part. Even in these developed economies with sophisticated tax systems, inheritance taxes are not the revenue gold mines that you might expect. The countries like UK and United States, that despite having high rates, generate only 0.6% and 0.5% of their total tax revenue, respectively, from state taxes. Why do they persist with it? The question is, why do they persist? Because these countries have something which India lacked in 1980s. They have robust institutional frameworks, transparent property records, and they have sophisticated tax administration systems. Now let's look at Germany's inheritance tax system. They have rates going up to 50%, and it works relatively better. And there is a specific reason for this. Germany has excellent record keeping systems, and it's a minimal cash economy. Most transactions are documented, they are traceable and verifiable. Now, there is France, which has reformed its inheritance tax systems multiple times and currently exempts most of the family businesses and agricultural land. And it recognizes that taxing productive assets can actually harm the economic growth. So, the question is, what is the key difference between those successful implementation of inheritance tax in some developed economies and the failure that India faced? These countries, those mature economies, those developed countries have mature economies with minimal parallel cash economies. They have comprehensive digital records and, most importantly, a strong rule of law. These were the conditions that India was still developing in the 1980s. Now, this brings us to another question. Does India tax inherited property in any way? The answer to this question is more nuanced than most people realize. Let's look at it. Under Income Tax Act of 1961, inheritance itself is generally not taxable as income under Section 56. So when you inherit your grandfather's house or your father's shares, you don't immediately owe income tax on receiving them. However, and this is a big however, if that inherited property starts generating income, that income is fully taxable. So if you inherit a house and you rent it out, that rental income is taxable. If you inherit shares and you receive dividends, those dividends are taxable in your hands. Now here is a provision that catches many people off guard. If you, let's say, sell an inherited property, then there is capital gains tax which applies. But here's the catch. The cost of acquisition for the tax purposes is taken as the previous owner's original cost, not the market value at the time of inheritance. This can result in significant tax liability, especially for assets that have been held for decades. Let me give you an example. Your father bought a house in 1990 for rupees 2 lakh. Now today it's worth rupees 2 crores. When you inherit it, you don't pay any tax for merely inheriting it. But if you decide to sell it for rupees 2 crores, your capital gains calculation will be based on the rupees 2 lakh original cost, not the current market value. Even for the inherited shares, the scenario is similar. The shares themselves are not taxable upon inheritance, but let's say any future dividends which are there, they are taxable. And if you sell them, capital gains provisions apply with original purchase price as the base cost and not the current value. Now let us having given some attention to that, let's talk about the constitutional framework, because this is where the debate gets really interesting from a legal perspective. Recent reports reveal that around top 1% of wealthy Indians, they own around 40% of country's total wealth. Let that sink in for a moment. Just 1% of our population controls more than 40% of our national wealth. Meanwhile, the bottom 50%, they sustain themselves with a mere 6% of country's wealth. Now, this extreme concentration of wealth, it directly contradicts some fundamental constitutional principles. For example, Article 39C of our Constitution, which is a directive principle of a state policy. It directs the state to ensure that wealth and means of production are not concentrated to the common detriment. While this is not legally enforceable, Article 39C is DPSP, it's not legally enforceable in a court. It represents moral and political commitment by the state. Now let's look at Article 14. It guarantees equality before law. Critics of inherited wealth, they argue that massive inheritance perpetuates inequality across generations, essentially contradicting the constitutional promise of equality. Now, supporters of inheritance tax claim that it will promote Article 14's equality principle by leveling the playing field. So, the policy arguments are compelling on both sides. Proponents of inheritance tax, they argue that inheritance tax could help reduce India's fiscal deficit by generating additional revenue, decrease wealth inequality, and fund social welfare program and infrastructure development. Now, on the other hand, critics they counter with equally valid concerns. It could, drive the capital flight in today's globalized economy. It could discourage savings and long-term investment and be practically unenforceable given India's still significant cash economy, and it could potentially hurt middle-class families whose primary asset might be an ancestral home that's valuable on paper but generates no liquid income. So here's the $1,000,000 question, or should I say a multi-crore question. Should India reintroduce inheritance tax? Based on my analysis of our past experience and global best practices, I believe answer cannot be a simple yes or no. If India were to reintroduce inheritance taxes, we would need to address every single issue that caused the spectacular failure of State Duty Act. Firstly, we would need to build robust digital infrastructure for asset tracking and valuation. And here's the good news: the success story of GST implementation and widespread adoption of digital payments shows that India now has the technological capability to handle complex tax systems. Second, we need to start with modest rates and high exemption limits. Instead of those punitive 85% rates of past, we should learn from countries like United Kingdom, which exempts states below 325,000 pounds. India could exempt smaller and medium states entirely, focusing only on the genuinely large inheritances. Third, the initial focus should be on transparency while bringing in inheritance tax, if at all we plan to bring it. The initial focus should be on transparency and wealth mapping rather than revenue maximization. Use inheritance tax as a tool for understanding wealth distribution and formulating better economic policies. Fourth, any inheritance tax should be coupled with a comprehensive tax reforms that reduce income tax rates for compliant taxpayers. It would create a positive incentive for the tax compliance. Now, the economic context today is fundamentally different from what we had in 1985. India has better institutions. We have sophisticated digital infra, a much larger formal economy, a stronger regulatory framework. However, there are significant challenges which still remain. We still have substantial cash transactions, complex joint family structures that make asset ownership at times very unclear, and there are still some gaps in our enforcement capabilities. So, whether inheritance tax makes a comeback will depend on a number of questions, such as how we balance competing priorities. Let's say immediate revenue needs versus long term wealth equality, administrative feasibility versus policy ambition. Given the wealth inequality that I initially mentioned in this video, where just 1% of Indians control 40% of our wealth, while half of our population survives on somewhere less than 6%. This debate becomes not just economically relevant, but socially and constitutionally imperative. So, as we wrap up today's episode, I would want to hear from you. Do you think India should reintroduce inheritance tax with proper safeguards and modern implementation frameworks? Or should we focus on strengthening existing tax mechanisms and improving compliance? Send me your thoughts via email or social media or in the comments below. So if you found this video valuable, I would request that you please share this video with others who might be interested in understanding India's complex landscape. Thank you so much for watching, and let's hope to meet you soon. This is Shashank signing off. Thank you.